Dr. Narayan, let me start off with you. There was a huge fall that we saw in the markets yesterday, 600 points gone on the Sensex. Do you reckon there could be lower levels today? And how should one trade this market now?
I'll answer the second part of your question first. I think the only way to trade this market is to keep buying the dips. The trend is pretty resolute. If you see across the last, let's say, 12-month window only, I don't think there has been a single occasion when the previous swing low in the market has been lost by the trend. So it's a very simple thing within technical analysis that at the very least some previous sets of lows need to be compromised. And if a market will not do it across the space of 12 months, that actually tells you the story about who's really in control. So it's very obvious what we need to do. We need to be buying the dips. So then the second question, therefore, is how do you define the dip? We have various ways of defining the dip through various techniques such as moving averages, trend lines, retracement levels, etc. I think there is a culmination of a retracement level and a trend line level support at about 87.50. We saw the index future drop down into those levels, and I think I would watch for that level to hold and for markets to revive. So my approach is to look to buy some stocks which have hit down into supports and are reviving from there.
Okay, good morning, Dr. Narayan. Point taken, but nevertheless, is there for a day trader a stop loss beyond which you may not recommend the buy on dips theory?
Well, speaking strictly for a day trader, if the index were to drop below 87.50, then it would have a room for about 100 points more, which is meaningful for a day trader, and therefore any day trader with a long position, either existing or freshly created, should have a stop loss on the Nifty at 87.50.
So, Dr. Narayan, you said that you have a buy the dips strategy as a positional trader. What would be the top buys in the Nifty?
Well, I think I would stick to the pharma and the FMCG space. That is the one showing the most amount of traction, even on good days and bad days. I think the tag of defensives is no longer applicable. Across the last 6 months, Hindustan Lever has probably given you what, 50% return. So I don't think you can really talk about these stocks as being defensives. They are actually creating tremendous amount of wealth on the go within a space of few months. Look at Lupin, look at Wokhard and all these stocks. They've been creating tremendous amount of wealth, and they are showing extremely good patterns, solid patterns on the charts. Fantastic momentum, fantastic volumes, great deal of interest to buy into them even at high levels. No, quite unmindful of valuations in the expectation that future growth will take care of the valuation parameters. I think those are all scenarios which are driving these FMCG stocks. I would still be a buyer in Hindustan Lever. I would be a buyer in Dabur. I would still buy Cipla. I would look to buy maybe Glenmark even at this level. So pharma, FMCG, I'm still happy to be a buyer.
Okay. Well, Dr. Narayan, wanted your view on two specific stocks. First, ICICI Bank. Does it put a bottom at 330 or 320, or will it once again test 285?
I think ICICI Bank has stopped leading from the front, right? So it's going to, kind of float in the tides which are being created by the other banking stocks. So there has to be some specific new event or reason for ICICI Bank to really kind of put in a strong bottom which it will not break, or against which you can actually go in there and buy the stock. That has not yet happened. So I don't think the bank sector as a whole right now has the kind of forward momentum. So I would think that the entire banking space is going to probably follow whatever trends are being set on the Nifty. So in that context, with ICICI Bank not really firing on all cylinders right now, I would not really think that whatever bottom has been created right now could be the bottom against which you could buy. So maybe the jury is out on that yet.
Okay, Dr. Narayan, the mid-cap space, what stands out for you in the mid-cap space? We have seen a motley group of stocks rising. But what would you bet on the long side?
Well, I think when you go out into the mid and small cap space, the selections are quite substantial. I would take a look at a stock like Navin Florin, which has been meeting up with substantial interest, and it's an area where the company's concerns have been doing well, and this is a stock which seems to have attracted fresh new set of players. So stock like that would be something, an interesting play. I would look at something like IFB Industries, which has had a fantastic run. Then it's been into a consolidation where it hardly lost any ground and was completely unwilling to surrender whatever had been gained recently. I think the numbers have really backed up the performance of the stock in the market, and we are actually seeing a fresh upside breakout, as it were, in the stock. I think IFB Industries is something that I would look at. From the old guard, I would probably take a look at Pfizer. I think that stock has also been moving up rather quietly. The other pharma stocks have actually kind of garnered all the spotlight, but I think Pfizer, being one of those erstwhile blue chip of all blue chip types, I think that's set to make a nice move. And one should probably take a look at that. I think all these 4-digit stocks are really powering themselves up. Forbes India, Dynamatic Technology, I mean, you name it, they're all there. ISGC, Heavy Engineering, these are all stocks that I think have this issue relating to lack of floating stocks and very heavy demand on the basis of very strong numbers that they are churning out, and the expectations that they will do very well. So the standard PE multiples are generally going out of the window as far as these stocks are concerned. I think there are plenty of those examples around. You could probably shop around for many.